After weeks of grinding higher, we've had our second red week in less than a month, and volatility is creeping back into the market. And with a loaded data dump involving inflation, CPI, PPI, and retail sales, volatility is likely to only increase. So in these volatile times, it's best to be objective and unemotional. So today I bring you nothing but the stats, the data, as well as the key levels. We're also going to be looking at sector valuation. We're going to be looking at what is cheap and what is expensive and what could be a value trap. We've got a lot to talk about, so let's roll the tape. Welcome everybody to the special weekend edition of the show. My name is Chase. Guys, if you like this video and want more of them, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out and get these videos to more people. Let's get into it. Now guys, I want to say one thing. It was my birthday today, or some of you yesterday, whenever you're watching this. The 10th of March was my birthday. Just want to say one thing. I put a post on my Twitter and I received so much love. I got 32 comments from all of you guys. So every single person that's on here, thank you so much for the support. I love you guys. You guys are awesome. I appreciate all the love and support, and you guys make this channel what it is. Now this is the weekly heat map of the S&P 500. There were pockets of green, there were pockets of red, but the standout stock in the red was Tesla right here, down 13% for the week. Having a lot of troubles with China, sales, competition. I also think one of their plants was nearly bombed, or there was a threat for a bombing in Berlin. Very rough situation for Tesla holders, and I do think it's going to go lower. I think Tesla's going a lot lower, especially if a stock is overvalued, decreasing free cash flows. I think this is going to see some serious downside, more to come. Bullish on the long term, but yeah, we saw software infrastructure take it on the chin as well, but semiconductors did pretty good. Nvidia up 6.83%, except for Broadcom on that earnings news they had. Other than that, pretty green in most other sectors. I mean, financials were very mixed, but mostly green. Also saw that like industrials, real estate, energy, utilities, basic materials, pretty green for the week. Healthcare was half and half. I mean, drug manufacturers were pretty red, but I think most of these guys are up like 12 to 30% for the year. So taking a bit of a breather. And then Costco was really the only massive red for the week in consumer defensive. But breaking down the sectors in chart form, we could see the best performing sector, GDX, along with regional banks, utilities up there. The worst performing sectors was XLC, software, technology, discretionary. So really like the mega cap trade, technology trade. I know these are individual sectors, but you know, we got like Tesla, Amazon in here, Apple, Microsoft, softwares like Adobe, all of the cybersecurity names, XLCs, Meta, Google. It's really the mega cap technology trade right here. But we actually had a lot of other positive sectors that a lot of people aren't talking about. A lot of people talking about this right here, but look at industrials up 0.64%, financials, staples, energy, materials, real estate, semiconductors up 2%. Very positive on the week, and this is a net good. I mean, more sectors gained in the week than actually lost, and a lot of this flows that did lose in technology had a lot to do with Friday's trade. Now looking at sentiment, this is the Goldman Sachs sentiment indicator and the BofA bull bear indicator. We can see that positioning is officially stretched. Now it's not to say we are going to sell. We can stay in stretch positioning for long periods of time, and the BofA bull bear indicator was actually at 7 not last week, a couple of weeks ago, and it is ticking up. So we got sentiment looking frothy, as well as BofA's indicator moving a bit back, and I do think that this is just a signal to probably hold as well as trim some of your winners. You know, if you do have winners in your portfolio, don't take them all off the table, but take a little bit of profit, hold some cash, wait for a pullback, wait for a better buy price, and if that buy price never materializes, you got a bit of cash, you're still invested. Not a bad thing to take a little bit of profit, especially in your winners, and look for more undervalued sectors that might perform, or even just wait out some volatility. Sometimes the best hedge is just taking some of your chips off the table. Now let's talk about OPEX. This is a trade we can look at taking, not this week, but the week after. There's a couple of things that need to happen this week for this trade to materialize in something that we can take in the week after. We're taking the trade pre-OPEX and post-OPEX, and essentially it is the S&P 500 performance in the 2-week March OPEX wraparound when the trailing month, the last 21 trading days, is positive. Now the last 16 trading days is up 1.84%. What we need to see is a flat or positive return in the next next 5 days of trading. If we can get that, we can take the trades in pre-OPEX week, looking for upside potential of 1.2%. And we could see here that every time this has triggered, 17 wins, 5 losses. So very, very positive stats right there. We exit the trades Friday, wait out OPEX, let OPEX week do its thing. Then post OPEX, we can actually come in with shorts, looking for 0.9% downside, 5 wins, 17 losses. We want more on the loss side. So we could be looking at taking longs into OPEX, taking money off the table, then taking shorts post OPEX into the April period. We also do know that based on seasonality, April can be very mixed. From a momentum factor standpoint, April is normally very negative and we are in a momentum based market. So taking a short here post OPEX could actually be very, very good as a hedge for our portfolio, especially if we do eke out pretty good gains. We can then move our stops to even and pretty much have a risk-free trade and hold a risk-free hedge throughout all of April. But I will keep you guys updated to see if this trade hits, if the parameters do fulfill, and if we do go ahead and take these, I will update you in next weekend's video. This is when we'll be taking this trade. So we'll be taking it in this week right here. This is the current week on Monday. This is going to be the open, where we want to wait for certain things to happen in this week to take the trade in this week. Then this is OPEX week right here. Now this is the monthly OPEX. We're actually looking at the quarterly OPEX, which is the 28th here of March. And then the post OPEX trade will be right here. So this week. So the 2 weeks we'll be trading in is this week right here, and then the week after the quarterly OPEX week. So in today's video, guys, we're only going to be covering S&P 500 mid caps as well as IWM, because I covered the S&P 500 full charts from the weekly charts all the way down to the daily yesterday. So go watch yesterday's video to see S&P 500 analysis, and today's video has mid caps, small caps. Now looking at S&P 500 mid caps, we can clearly see we are in an uptrend and breaking out. Now zooming in, looking at this most recent candle, number one, it's a weekly close at all-time highs. This right here was the previous all-time high that we made. We've officially closed at all-time highs on a weekly basis. That is bullish. Now looking at candle structure and location, we can actually see a lot of indecision right here. We got a green bodied candle with a huge upper wick and a fairly average lower wick. I would say we did gap up. We did finish higher on the week, so you would say a win to the bulls. However, bears did come in and take us all the way back down to pretty much the middle of the candle. It's not a win to the bears, but there's definitely some bearish momentum right there. That being said, if you zoom out, look at the trend, we are in an uptrend, making lower highs as we moved higher into an all-time high, at the same time making higher highs, as you can see right here, and then an all-time high. That is bullish. Now on a weekly chart, I will only actually go ahead and be bearish if we do go ahead and break this level right here, the 27.44. The reason why this is an absolute key level is because we used it as resistance right here, here, and here. We then turned resistance into support, kind of, and then we rallied all the way to all-time highs. So this is a very, very key level right here. So if we pull back on a weekly chart right here, still very bullish, looking at higher price action. So on a weekly chart, we can pull to 27.44 and still be bullish. However, if we do go ahead, break below, especially if we go ahead and break below the 26.76 level, that's going to be grim. And then we can see actually downside flows to as low as the October lows here, 23.24. However, that is a while away. And if we actually measure from where we currently are to this level right here, it's 7% below. And especially with making new all-time highs and being in a technical uptrend, it's going to be very hard for bears to actually take us all the way there. And even if we do get there, still bullish. And this is a very key level. I will look to add extreme longs if we do get there, looking for higher price action to new all-time highs. Looking at the daily chart, let's get more nuanced look at the daily chart. Let's just zoom out so you can see the trend right here. This section was the October low, start of November low. We then had a spectacular rally, and if we actually go ahead and measure from the lows to the highs in mid caps, that's 28.8% in just a couple of months. Actually kind of crazy. Now looking at the week just past, we could see that we started Monday right here. This is Monday, Tuesday, Wednesday, Thursday, Friday. Very volatile day on Friday after gapping up and then selling off on Nvidia flows, mixed economic data, especially leading up to CPI. The market wasn't sure and it was a lot of risk off, leading into what culminated into a red bodied candle where we actually got above the 3000 level in the S&P 500 midcaps, or just below the 3000 level in S&P 500 midcap, and then closing pretty much at yesterday's lows or yesterday's open. However, we actually didn't go ahead and break the weekly low, and that's a win to the bulls. All in all though, looking at this, it doesn't look too good for the bears based on this candle structure. Now, what do the bears need to do? They have a lot of work on their hands. The bears need to do one thing this week, and that's push below the 2908 level. They need to keep up this bearish momentum, push to this week's lows, get below, use as resistance, and then push into these lower levels right here. The levels below 2908 that the bears really want to go ahead and take is this level right here, 2794, and then the one below that is this level right here, 2745. If they can go ahead and take that and close the week somewhere around here, that would be insanely constructive for further price action. What do the bulls need to do? They just need to hold this 2908 level. So even though this does look bearish, there's less work on the hands of the bulls because they have a lot of room to work with. You could wait for a sell all the way to here, look for buy side support, take longs, and if the bulls do go ahead and do that, that would pretty much be an equal low or a higher low if it's above, and then go ahead and make new all-time highs. That would be trend continuation. So bears do need to put in more of the work, especially in this monthly OPEX week. But if we do get below 2908, it's going to look a bit grim for the bears. However, a lot of trade needs to happen this week. We don't have a dense week of earnings, but we have a dense macro week, especially leading up to FOMC the week after next. However, guys, I will keep you guys updated with what the technicals look like for mid caps, small caps, and the S&P 500 every single week. So go ahead and follow me down below. And it's very, very simple. Just to recap, shorts below 2908, looking at 2794, and we're looking for a weekly close in this area, and that will mean further downside action. The bulls need to hold 2908 and look for new all-time highs. That's the game plan. Now, looking at the IWM, this is the weekly chart. Zooming in, we can see that IWM is sort of like attempting a breakout right here, coming out of this huge zone of consolidation that we've been in since early 2022, late 2021, as you can see right here. Now, zooming into this week's candle, looking at location and structure, this is a long leg doji, a lot of indecision, slight win to the bears simply because it is a red bodied candle. However, we did gap up. Bears came in at the top, bulls came in at the bottom. There's a lot of indecision in the market, and a lot of next week's trade is going to be predicated on what happens. I think if we go below this low or above this high, we'll see flows continue in that direction. Now, on a weekly chart, this is actually bullish simply because if we do zoom out, we can see we made a low right here, then we made a higher low, higher low, higher low, all the way up to go ahead and actually get out of this huge consolidation zone. We made a high right here, we broke this high, and we've actually made a 52-week high in the IWM. However, we haven't broken the high made in early 2022. That being said, on a weekly chart, I remain bullish on the IWM until this level right here is broken, this level. Now, we can actually wick below this level to as low as there, but with how weak small caps are, it's 191. We can sell all the way to this level and I would still be bullish, but we need to find a bullish support right here and then move up and go ahead and break these highs. But what I really want to see IWM do is just break above that high right there and ultimately go ahead and break above this high right here. If IWM can go ahead and do that, that's bullish, and it opens up higher levels right here and then all-time highs. Now, looking at the daily chart, looking at the last week of price action, we can actually see that this right here, that's the weekly pullback level that we remain bullish to. So on a weekly chart, we can pull back up to there, still be very bullish. Now on a daily chart, what can we actually look at? So we can see the last 5 days of trade, 1, 2, 3, 4, 5. Now we did gap down here Monday, Tuesday, and then rally, where we saw a lot of volatility on Friday after the huge gap up. Bulls did take us higher, but bears came in and shorted all the way to the bottom. So this doesn't look too constructive for the bulls. However, I remain bullish on the IWM on the daily chart until we actually go ahead and break this level right here. If we go ahead and break this level right here, which was last week's low, then we can actually look at downside momentum to key levels right here and then the 191 level. But if we go here, pull back, find bullish demand, and then go higher, that's what you really want to see. And that's what the bulls want to do. They want to come here, find some support, move higher, right? The bears want to do is get below this line, and then sell, breaking this level and then finding 191. The bears really want to close this week inside this area right here between 191 and 203. Bears really want to close inside this level. If they can go ahead and do that, that really opens up a lot of indecision. But do remember, on a weekly chart, we are bullish above the 191. It's just that we can see downside flows to this level if we do get below the 203 level. All in all, you do zoom out and you can actually see very bullish for the IWM from the October lows to where we are right now. We're looking at a 27.8% increase in price, and that is bullish nonetheless, although the IWM is taking its time on this breakout, and that's not necessarily a bad thing. It's just that you have to have a little bit more conviction in your play. Now let's talk about the macro. Big week of data next week. We have CPI right here, PPI. That's going to be the big points of contention. We also have FOMC on the 20th of March, so not next week, week after next, but there's going to be a lot of discussion and price discovery with regards to FOMC next week, especially in the rate market. We also have a couple of other big things. Retail sales, that's going to move the discretionary names, the staple names, and then we have the usual initial jobless claims, budget statements, mortgage applications, Michigan sentiment, industrial production, the same old in and out data points we have every single week. But the big ones, CPI, PPI next week. And I do think that CPI is going to come in a bit cooler than both expect, simply because in January, everybody raises their prices at the start of January, and those are really hard to seasonally adjust for. But what we can expect in CPI is a 3.1% and 3.7% year over year. This is headline, this is core, and on a month over month basis, 0.4%, 0.3% in headline and core. And on the PPI front, so we got ex-food energy, the headline, and then ex-food energy trade. So we got headline, core, super core, 0.4%, 0.2%, and 0.3%. Both as estimates right here are actually the consensus figures for both the CPI and the PPI. Now, we also have earnings next week. We are still in earnings. 493 companies have reported. Not a big week of earnings, but we do have stuff like Oracle, Adobe, Williams-Sonoma. We also have Ulta Beauty reporting, and other names like Dollar Tree, Dollar General, Dick's Sporting Goods. Not a big week of earnings, but there can be some volatility in like software, staples, discretionary, if you really go ahead and look for it. But looking at the earnings scorecard, currently we're doing really good for earnings. 493 companies have reported 10% blended earnings growth so far for the quarter, 13.6% excluding energy, and the best sector is comm services. If you look at technology, 24.2% return right there. And the only negative sectors in earnings have been healthcare, materials, and energy. On the revenue front, 3.7% revenue growth in the S&P 500, 5.1% excluding energy. Now, where does all of this leave us with the valuation? Currently, the S&P 500 trades at a 20.8 PE and a PEG of 1.4. So it's getting very pricey, very close to 21 times. Very frothy. This is the next 12-month PE ratio right there. Even these sectors that we deem to be of value, stuff like energy, financials, now, getting up there, still pretty cheap, 15.2 times, 12.2 times, but, really moving up. Financials was like a 12x PE like 3 months ago. Energy was at 10. I think at one point I saw it at 9.8 times. Ridiculous. Now, information technology and discretionary are the most expensive sectors, trading at 28.5 and 24.9 times earnings. I still think the best value that you can buy right now with regards to growth is comm services. It trades at an 18.2x PE, a PEG of 0.9, and a free cash flow yield of 5.2%. If you're looking for growth at a reasonable price, go ahead and eye out some names in comm services. Google, Meta, Netflix, Disney, Roku, Fubo, those names. You're going to find a lot of growth and a lot of value in those names as well. I also think that real estate, there's good value in real estate right there. The metrics don't look so good, but a lot of these stocks, if you do dive into it, are trading at 30-40% under fair value. And that's also a play. Sometimes the forward metrics might not look that good, but if you can get it like at a deep discount to its fair value, that's actually still a good buy. So yeah, look at comm services, look at real estate, especially if rates are going to come down. You want to hold for 3, 6, 12 months into the future. And if you really want to pay up and look for exceptional growth, look at information technology and discretionary. Now, here is BOFA's take on the macro, guys. I just thought I'd give this to you guys. So this is from this, and I've just gone and done up the points. Now, they expect payrolls to increase by an average of 150K per month in 2023. 2024. They previously expected 107K. They now expect peak unemployment at 4.1%. We're currently sitting at 3.9%. They expect headline and core PCE to fall to 2.6 and 2.3%. They expect real GDP growth of 2.5%, and they expect the Fed to adjust its pace of balance sheet runoff in May, and that coincides with probably when the reverse repo is going to be depleted. Now, let's switch gears and talk about Gamma. Now, guys, what I was actually going to do is go ahead and actually explain this entire chart in depth to you, but I ended up making like a 20-minute video and it was just completely confusing. So what I'm going to do is not do that. All I'm going to tell you is how to use this chart every single day to pretty much predict what the market's going to do. And then I'm just going to refer you to reading in the description below. So I'm not going to dive into the intricacies of dealer hedging, Vanna and Cham flows, and the options market, because it actually doesn't really matter. So how to use this chart, right? So very, very simple, guys. This just shows the gamma environment dealers are currently in. So you can see right here, dealers are in a positive gamma environment. And you can see right here, dealers are in a negative gamma environment. So in a positive gamma environment, retail has sold a lot of calls to dealers. Dealers have bought it and they've hedged their books by shorting stock, right? So as the market goes up, they're going to short to re-hedge their portfolio. As the market goes down, they're going to cover some of those shorts. And that's why you buy dips, sell rips in a positive gamma environment, because as we get here, dealers generally tend to short stock and cover their shorts as the market goes higher in a positive gamma environment. The market, for the most part, is almost always in a positive gamma environment, and that's why bull markets tend to last for a very long time. Now, in a negative gamma environment, it's literally the opposite to a positive gamma environment. Instead of buying into weakness and selling into strength, dealers buy into strength and sell into weakness. How do you know if you're in positive or negative gamma? Well, this right here, the HVL, this is the gamma flip zone. We move below here, we flip into negative gamma. Above here, we're in positive gamma. So we buy dips, sell rips right here, whereas in a negative gamma environment, we look to hedge our portfolio, especially for downside. In a negative gamma environment, we do get downside momentum. However, it's very, very snappy in a negative gamma environment. You can get whipped in and out of your positions very, very quickly. Now, normally we look at these nodes right here, this node, this node, this node as key areas where dealers want to take us to the upside as well as the downside. So these act like magnets, and generally you can see, like we did, we closed the week here at 150, 51.57, and then 51.50 was actually the node. So on the day and on the week, we gravitate to these, but all in all, we definitely gravitate to the core gamma strike, the biggest gamma strike the most. And you generally find around OPEX, we have trade right here, unless we move up and then we'll move up the tape, or we move down, then we'll move down the tape. Generally in OPEX week, you don't really see much of this movement. Generally in an OPEX week, wherever you are at the start of the week, that's generally where you'll end the week. Now, after options expiry, all of this gamma and all of this gamma gets removed off the tape, and then you enter the window of weakness. And that is this area right here. You enter the window of weakness, and it's pretty much from Vixpiration all the way to the last week of the month. So you pretty much have 7 to 10 trading days where you are in the window of weakness. Vanna and Cham on a holiday. Dealers don't support the market as much because there's not much negative gamma or positive gamma in the tape. And normally, if we are in a positive gamma environment where we have been rallying into OPEX, we can actually see downside towards that. If the majority of the time we've been selling into OPEX, when we do enter the window of weakness, we can actually see a little bit of upside. Now, it's not to say that the market's going to absolutely dump or we're going to rally when we do enter the window of weakness. It's just that those positive or negative dealer hedging flows are just not there in the market. And that's essentially how you use the two, the window of weakness right here, and then, the window of strength, week 1, 2, and then the OPEX week. So this right here, this structure, along with knowing where we are in the gamma cycle, if we are in positive or negative gamma, and where the core gamma resistance strikes are, those are the only things you need to know. Now, with all of that knowledge, putting it all together, looking at the week ahead, we can see that the core gamma resistance is at 5200. This acts as a magnet. We are above the gamma flip zone right here, so we are in positive gamma. That means we can buy dips, sell rips, look for upside potential to the 5200. We can then also look to the 5200 area as a big resistance zone where the market is going to reject. After OPEX, we want to see where the core gamma resistance repositions itself. Is it going to move up to 5300, 5250, or 5200? Is it going to stay here? Is it going to move down? And then we have to see how gamma builds into the tape during the window of weakness into the window of strength. Are people getting more negative? Are people getting more positive? Those are the things we want to look for. Generally speaking, in a positive gamma environment, you want to buy dips, sell rips to the call gamma resistance if we're below it. If we're above it, you generally just want to play mean reversion trades in this level and wait for it to either move up or down the tape. Generally speaking, if we are above the call gamma resistance, it moves down the tape, we will probably sell to that level. So being in positive gamma doesn't necessarily mean we're always going to go up. If the call gamma resistance moves down the tape and we're above it, we sometimes can actually sell to that level if that happens. I hope that really helps with everything and helps you understand these charts. Please let me know in the comments if that helps you at all. Now, if you like this video, please subscribe, hit that notification bell, like this video, guys. Cheers.